Good morning, everyone. A warm welcome to this session. I am Kalpana Kutti from PG and Research Department of Commerce, Arulmigu Palaniyandavar Arts College for Women, Palani. In this session, we are going to see cash flow statement and how to prepare cash flow statement. Let's go to the session. The first one is cash flow statement. It is one of a business most important financial reports. We all know some financial reports like income statement and balance sheet which concentrates on accounting profit. Unlike these two, a cash flow statement deals with the component of a cash component of a business. Since cash provides liquidity, it is decisive for the survival of business. It records a firm's all cash based transaction during a particular accounting period. In other words, it mirrors the availability and usage of business funds to reveal its current state of liquidity. Okay, then let's go to how to prepare cash flow statement. The first step is we have to take opening cash balance or bank balance available at the beginning of the accounting period. And then the second step is we have to add all the incoming cash from various sources, that is cash inflows like cash sale of goods and services, proceeds from the sale of assets or investments, the funds acquired by the issue of shares or through bank loans, etc. And the third step is we have to subtract the cash outflows, outgoing cash from various sources like salaries, dividends, rent, insurance, loan repayment, stock purchase, taxes, etc. Also deduct the money invested in business projects or offered as a loan. Then the net amount so evaluated is the cash in hand remaining with the company. Okay. For preparing cash flow statement, we have to understand three categories of activities. The first category is cash flow from operating activities. It includes cash used or generated from the daily core business activities. The operational activities are the principal revenue generating or expenses incurring activities of the company. It includes selling goods or services and payment towards expenses like salaries, taxes, etc. Then let's see what are the cash inflows and outflows from operating activities. First, cash inflows. Sales revenue received from customers, the commission, brokerage, royalty and other fees received. Receipts from debtors and cash outflows, that is rent paid, cash payment to suppliers and vendors, salary, wages, commission paid, taxes paid, purchase of stock in cash, freight and other expenses paid. Okay, then let's go to the second category, that is cash flow from investing activities. It represents the outgoing or incoming cash from acquiring or disposing of companies' long-term assets and holdings. That assets includes land, property, plant and equipment, investments in other companies, etc. Then let's go to the cash inflows and outflows of investing activities. Cash inflows. Proceeds from the sales of fixed assets. Cash is received from selling investments in other companies like bonds, fixed assets, equity, debentures, etc. Money received on maturity shares, debentures and bonds. Dividends and interest received on investments. And the cash outflows are purchase of fixed assets, buying of shares, debentures and other long-term or short-term investments instruments issued by other companies. And the final category is cash flow from financing activities. It shows the capital receipts and payments marked by the transaction with the corporate finance providers like banks, shareholders and promoters. Then let's go to the cash inflows and outflows. Okay, first cash inflows, proceeds from borrowings from banks and other financial institutions. Proceeds from issuance of the shares and debentures. Okay, then outflows are repayment of borrowings and loan installments, buyback of debentures and shares, interest paid on loans and borrowings, dividend paid on shares issued. Okay, for preparing cash flow statement, there are two methods. The first method is direct method and the second method is indirect method. Under these two methods, cash flow from investing and financing activities, there is no changes. You have to add all the cash inflows and then subtract all the cash outflows. Then the net amount is to be taken. But for operating activities, there are some changes. Okay, let's see what is direct method and indirect method. In direct method, only the operating items are recorded. This method is relatively easy to understand as it considers the actual cash transaction. The cash from operating activities can be straightaway computed by adding all the cash receipts and deducting all the cash payments. Later, the cash from all the three activities, that is operating, investing and financing, can be summed up to get the closing balance of cash or cash equivalents. Okay, then the Financial Accounting Standard Board and International Accounting Standard Board, they suggested to use direct method for preparing cash flow statement. The second method is indirect method. Under this method, cash flow statement prepared through requires adjustment of the non-cash items which are earned but not yet received. These changes are made to the net profit or loss of the company in the particular accounting period. The non-cash and non-operating expenses are added back to the net profit or loss, while all the operating and accrued incomes are subtracted. Thus, it is the reverse treatment of income statement and provides operating profit before the working capital changes. From this session, you all get a good idea of cash flow statement and how to prepare cash flow statement. Thank you all.